What to do when a strike is breached? What to do when a strike is breached? Man, if we were to count the number of emails we receive, Tony and myself, when a strike is to asking what to do when a strike is breached, I think I answered about 10 last night alone. What to do when a strike is breached?
People get into it by selling premium, not wanting it to be that level, and then there they are, and that's the problem. They're worried about what now.
It's whether it's a naked position, whether it's a defined risk like an iron condor. What to do when a strike is breached is a really challenging situation, and so let's talk about it.
I'm ready.
We have a very committed, very mechanical approach, and we don't vary from it. Mm-hmm. Let's go next slide, Beth. When a trade comes under pressure, we often talk about rolling the untested side. Recently, we also shared a study on how to adjust or defend a trade, especially when losing. Viewers have since sent tons of follow-up questions on what to do, how to roll a position, when either the strike has been breached or just challenged. We don't even wait for a strike to be. If we have the option, we do not wait for the strike to be breached. If we don't have the option, then there's nothing you can do.
Yeah, like if you got to move like Tesla today, where it's just up $20 some odd right in the opening.
Let's go to the next slide. So first of all, what is rolling? Rolling the untested side means that during the trade, if the stock breaches the strike, and now again, it's easy to define this thing by talking about breaching the strike, but if the stock makes you uncomfortable, it does not have to breach the strike. If it just makes you uncomfortable, we would close out the side that is untested, not a loss. And okay, what this means is we would roll up the untested side. What that means is you close out the option that is being untested, like they say here, and then you're going to open another option that's a little closer to the stock price. Mm-hmm. Basically, I don't want to make this sound too complicated or it's like two different trades. It's a single trade. It's just you buy back your short option, you sell another option out that's closer. That's all it is. It's a single spread. It's not a leg. There's no leg risk involved. It's just an additional credit. And the reason you do that is to reduce your delta risk and to add credits. Reduce delta, add credits. Mm-hmm. Let's go next slide. So by closing out the option that is untested and opening a new one that is close to the stock, we will receive a credit and will lower our delta exposure on the position. That is exactly correct. The result is a lower probability of making max profit in exchange for lower day-to-day risk and lower outlier exposure. This is defensive in nature. Beautifully said. That's exactly what we do. We don't touch the tested side, and on the untested side, we just roll it up if it's a put, and we roll it down if it's a call.
That is
correct. And again, this is not something that requires additional capital. This is only to mitigate risk and to reduce the volatility of the trade. That's all this is. Let's go to the next slide. So we looked at a study since 2015. We sold 16 Delta Strangles, 45 days to expiration, no early management in this study, which is not really what we do, but for the study made it cleaner. We recorded the occurrences where the SPY breached either strike. In our real world, it doesn't even have to come close to breaching. It just has to make you nervous. And also, it's the same thing for defined risk trades, except you just roll up the spread. We compared the average win rate, and we looked at exiting the trade when the strike was breached, continuing to hold until expiration, or rolling the untested side to make into a straddle or anything else, and then held to expiration, just to see if we can improve upon how much adjusting really improves upon doing nothing. Let's go to the next side, or closing out a trade. Like if you put a stop order and you close out a trade, that's not our style. Let's go to the next slide. So this study takes one specific example and method of rolling. The correct interpretation of the results should be a comparison to show the effect of rolling in general. Do not use the specific percentage, the premium over buying power numbers, as expectations for your own account. It's kind of like a disclaimer. Let's go to the next slide.
Mm-hmm.
Next slide, Beth. Okay. So rolling the trade gave you a better chance to break even than either closing immediately or continuing to hold. Now, again, we are not comparing these. There's no managing early here or that kind of stuff. And there's no other kinds of rolls. What we're saying is that we know two things that don't work. Stopping yourself out is the worst thing you can do. And you'll see the results in a minute. Mm-hmm. Continuing to hold, okay, is better than stopping yourself out, but it doesn't quite compete with adjusting the trade. So when rolling, you lose the ability to make max profit on the original trade. But on average, doing nothing saw more losses and collected less credit than the occasional full swing reversal. So what we see here is since 2015, using 10 years of research, it's a really good study, strangles with tested strikes. And for the purpose of this study, tested meant breached. If you exited the trade, your win rate was 36%. Not good. If you continued to expiration, your win rate was still 73%, which is not bad at all. And if you rolled to a straddle, your win rate went up to 78%. Remember, the expected win rate was 68% or whatever, plus a little bit higher than that, whatever. And so, but you make less money, but you kept your win rate high and your risk low. That's exiting a trade, holding to expiration, or rolling the untested side up to a straddle. It doesn't have to be that dramatic in real terms.
Sure.
Let's go to the next slide.
Yep.
The reason we rolled to a straddle here, by the way, is because we were waiting for the stock to be breached. If we were doing it normally, just when the stock made us nervous, we rolled. If we were doing that in the future, that would be very different. And you wouldn't roll to a straddle, you just roll to a higher strangle. Historically, around 40% of strangle saw at least one breach. Actual probability of a touch. Remember, 16 delta strangle, probability of a touch of one side is about 40% throughout the 45-day cycle. Knowing a defensive tactic when markets get hard or get difficult will come into play often. And rolling the untested side reduces the delta exposure, increases the net credit, and increases the probability of breaking even or making a small profit in exchange for giving up max profit potential on the trade. If you're not subscribed, subscribe right here. And if you want to meet me and the team in person at our next live event, hit the link at the top of the description.